Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. And welcome back to Cash Talk. Today I'm joined by Mason Thorn. Mason, how are you, mate?
Going well, thanks, mate. It's been a while since I've been in this chair.
Ooh, you like it though?
I love it, actually. I really love it.
Nah, good to have you back, mate. Good to have you back. So, Mason, always in the world of money, there's things moving and there's always different topics to cover. But today we wanted to dive a little bit into the investing world. So speak to me. What have you been hanging to talk about on the podcast?
We're going to talk about investment strategy today and creating an effective investment strategy, because I think a lot of the time people go in with no real strategy. So I'm going to say investing, but what for? And why is the strategy important? I think it's a really good topic to sort of dive into today.
100%. I think that when people come to investing, there's there's very, very minimal planning strategically in regards to their investing, which then causes them to be maybe going off course when they don't realise. And so having an effective strategy, investment strategy to me, really means that it's effective in getting to the goal that you're trying to get to when and how you can, with confidence and certainty. When you're talking about effective investment strategy, what does that mean to you?
Yeah, it's a really good question, isn't it? And it means something different to everyone because we all have different goals and what we're trying to achieve. So if we talk to a young person, for instance, they might want to buy their first home. So that investment strategy is going to be very different to someone who's trying to build wealth for retirement, because very different time frames. And time frames is such a crucial thing when it comes to investing, because we know some investments have high degrees of risk and high degrees of volatility, whereas other investments have lower risk and lower volatility. And each investment has its own role, but choosing the right one for the right goal is so crucial. And I think a lot of time we have very short-term thinking, and we say, we're going to dive into shares without the thinking of, it's a really long-term asset to hold. If we're saying for a home, for instance, that's probably not the right vehicle to use. So for me, an effective investment strategy is very much, as you say, looking towards the goal first and then deciding on the product afterwards.
Very, very good summary in regards to the effectiveness of an investment strategy. And I don't think a lot of people that I see that come through the doors have that level of analysis done on their investment strategy. Would you find, like I do, that a lot of people just simply are investing with the hope of getting somewhere?
I think so. I think it's very much a throwing a dart at a dartboard and hoping it sticks. It's like, hopefully that works. And they haven't really thought about, why am I even doing this? And what kind of return do I even need to achieve that goal? It's really difficult. And often it's done the exact opposite way. I think with a lot of clients, I see their superannuation is probably not invested aggressive enough, and yet they're too aggressive on the short-term things.
So money's not in the right kind of buckets.
Absolutely. It's definitely not in the right buckets.
So when we obviously talk about having money allocated in regards to buckets, and it's a big precursor on making sure we have an effective investment strategy for people. So speak to me around how you would like to see your clients' money from a bucketing perspective to make it effective.
Yeah, so we often go with a 3-bucket approach. So you have your short-term bucket, you have your medium-term bucket, and you have your long-term bucket. So for most people, that long-term bucket consists of superannuation. Can't touch for a long period of time, therefore we can afford to take a bit more risk in that bucket, whereas we might have a medium-term bucket, which is that 3 to 5 year space where you can take a little bit of risk, but not too much risk, because we need that money in the short to medium term. And you have that other bucket from 0 to 3 years. So that's a really short-term bucket. So you don't want to take too much risk in there because we need that money in the short term. So that bucket might consist of things like your cash, your term deposits, things like this, whereas that longer-term bucket may consist of things like your shares, your property, things of this nature. So when we're talking about different goals for our investment strategy, so if we're thinking about buying a house in the next 3 years, we want that in cash and term deposits because we're going to need to access that money for a deposit. Because you can imagine, John, if we invest that money into shares and there's a market downturn, your deposit can deplete really quickly. Then all of a sudden, your whole goal's gone because, I've lost my deposit. And that stretches out that goal further. So you can see why having an effective investment strategy is so crucial from the onset before we start investing to get to the goal.
Yeah, and this methodology is quite well known, and it's something that's kind of been proven over a long time to now ensure that money's in the right place at the right time. And it's something that we see very often just done incorrectly. I don't know if it's because of knowledge, if it's because of discipline, a bit of a mixture of both. But just consistently, I see people doing it wrong. And if you've got that short-term kind of money in a long-term arrangement, and if you've got a lot, it's riddled for disaster. The next bit of the effectiveness, once you get that right, is another common one I see is tax effectiveness. Too many people invest without taking tax into consideration, and they find themselves donating to the tax office, as I put it, unnecessarily. And you do need to pay taxes. Taxes are a part of your investment strategy, but if you can minimize that as much as possible, why not? So, Mason, what are maybe some of the common problems you see when people are not tax effectively investing? And what's some common things that we look to resolve for them?
Yeah, tax effectiveness is a really big one. And I think it's often we complain about tax, but we don't give it a second thought when we start investing, as you say. So I actually had someone come in the other day and they have investments in their own name and they're taxed at the top marginal tax bracket. So they're taxed at about 45%. Ideally, we don't want to be giving half our money away to the tax office. So investing in their personal names definitely was not tax effective. There are other vehicles we can look to use. So superannuation, for instance, tax at 15% rather than that 45%. But we have that trade-off, don't we? That we're locking that money away for a long period of time. So that may not be effective for these people in this goal. But there's also other strategies we could potentially use. An investment bond, where an investment bond you're taxed at a maximum rate of 30%. That could be an effective tool for them as well. But again, timeframes come involved there too, because there's certain rules around the investment bond. So there's so many different avenues we can go down. So as part of this process, we really need to understand what this money is for before we then go ahead and invest. But I think a lot of time we just dive right in. We might read something in the paper, or a friend might mention something. I'm going to buy this share, and then it's like, I'm going to go in and don't even give it a second thought.
So there's not a second thought with this particular client. Did you understand the reason? Just out of curiosity, did you understand the reason why they did that? Like, because from my perspective, it's always understanding the structure and what we're going to do. Did you understand that, or did you have a conversation about that? And sorry, I'm a bit nasally, so.
No problem. Yeah, we did have a conversation around this, and I think it was a lack of knowledge of the different options. It's like, I think if I'm going to invest for myself, it has to be in my own name. Sounds logical. So if you don't know, then you don't know. But for these people, these people want to invest for their kids as well. And investing for kids is also a very challenging area. And often it's like, I go and invest just in my name and I'll give the money to the kids later on and then solve the tax problem down the track.
So tax, big one. Yeah. So you got buckets, making sure things are set up in the right risk bucket and time horizon. You've then got the tax effectiveness and the overlay. So you've got goals, risk, and taxes. Mason, how much do you invest? Like, I was speaking to a client this morning, went for a walk with him, who's also a accountant as well too, smart guy. And we were talking about, like, once you've set yourself up, once you figured out that number, how much more do you want for your children? So when we talk about effectiveness, when we talk about goals, how much do you invest, and does the goalposts move?
That's a massive question.
Huge, yeah?
Massive question. Do the goalposts move? All the time. All the time. Because we can't predict where we want to be. Like my 20-year-old self is very different to my 30-year-old self. In that 10-year time, my goals have changed dramatically. And this is for everyone. So yes, the goalposts do move. But to answer your first question, how much do we invest? I like to work it backwards. So what's our target? If, let's say it's $1 million. Okay, we want to have $1 million by age 60. We think shares could potentially do roughly, let's say it can do conservatively 7% a year over the long term. How should I need to invest each year to get to that goal, and then work at that backwards? And you can divide it into a monthly amount, even a weekly amount. So really break it down. So, okay, if I invest this much each week, I know I'm going to get there.
And so you're reverse engineering that. And then to come up with that $1 million figure, how do you come up with the long-term goals for our clients? Because like I find a lot of people, they'll come out, they'll say, I want a holiday, I want a car upgrade, I want to send the kids to a certain school, a house I want to make. But when it comes to like retirement or financial freedom, how do you figure that out? Because it's like, that's what I'm investing for. I'm investing so that, like, how do you go through that? Like, what's beyond the 1 million?
It's a tricky one because we sort of have to put ourselves in the shoes of our future selves and what we think we're going to like at that point in time. And then again, reverse engineer it back. But we know it's going to change. So it's always good to allocate more than we think we need to, because we don't know what we're going to need. And you don't know what your circumstances are going to change. Like maybe you want to downsize, or maybe you want to upsize. There's all these different things. Maybe you want to move up to Queensland. So many different things. But we want to make sure that we are actually aiming for the right thing. And if we need to pivot a little bit, we can pivot a little bit. But as long as we're on the right track, then we can go forward from there.
So my hearing makes in that you need to kind of work out like the asset value to fund their retirement, like fund their lifestyle, sorry.
Correct. Or future lifestyle.
Future lifestyle. So for the mathematics out there, or the mathematicians, we're trying to work out essentially the number they're going to need where they could earn a rate of return based on their risk tolerance or risk profile to then see out the rest of their lifestyle where the tap turns off.
Correct. And often as we get older, our risk tolerance changes. Because once we stop working, often we see people become more conservative because there's no more money coming in. Therefore, this money needs to last me this amount of time. So we go more conservative. So let's say
because they want more certainty.
Correct. You want more certainty.
And that's all. And that's just, I want to stop on that point. It's not you waking up one day and going, I need to move from a high growth investor to a balanced investor. What's changing is the certainty, isn't it?
Correct.
So when you're accumulating wealth, that's why you can take on risk, and especially with long time frames, because you don't need so much certainty. But if you need the money for your wedding in 12 months' time, you need certainty.
Yeah.
So the investments, where they sit, is all based on the certainty level. And then the less certain you need to be, the more volatile the investment can be. And so over the long term, figuring out that number, which obviously I've had to do for a lot of people, is so different. So different. You know, if you've got a person that can live off $70,000 a year in comparison to someone that needs to live off $700,000 a year, the number is completely different. Which brings me back to the effectiveness of the investment strategy. Ultimately, the investment strategy's effectiveness is did it come to fruition?
Yes.
Did you achieve what we set out to achieve? And that's why the goals are so important.
Yes.
The fee efficiency, the tax efficiency, they're all just taking off the shackles that are holding things back. And then the investments themselves is to create the probability of getting to there. And then the way that the assets are actually held is then based on the certainty. And so in my over 2 decades of doing this now, I don't see a lot of people thinking about it that way.
No.
They just put $1,000 in Vanguard, some in ETF, and hope I get there.
Correct.
Pretty daunting for people that are just doing that, isn't it?
I think massively so. Because as you said, we've talked about tax effectiveness and these types of things, but what about the behavioural effectiveness? Because sticking to an investment strategy is what's going to make it effective at the end of the day. So how can we eliminate the human emotion from the investment decision. Because often this is where the investment strategy falls down, is when we see a market downturn and then we forget about the strategy. It's like, oh, no, I need to sell everything now. This is where the buckets are so important, and it's why an advisor, as that third party, unbiased view, adds so much value. Because that decision you make in that point in time can change everything.
Because you're right, you can set up everything we just talked about, and it can get unraveled by a dumb decision. And I'm not talking about a dumb decision about maybe picking the wrong investment. Actually, the difference between picking stocks and property is probably going to be minimal in regards to making an emotional decision the wrong way. And so why people fail on the goals they're trying to achieve, and if we talk about effectiveness, because most people focus on the investments and what we just talked about, the most effective thing is to stick to it for 20, 30 years. And so when you talk about the behaviors, not a lot of people are successful. If you actually think about it from a numbers perspective. You know, we're working with someone at the moment, they're with one of our advisors, and everything's cool in his life. And he wants to stop interacting with an advisor because he wants to now put all of his money towards his debt. There's no logical reason. The modeling doesn't do it. Trying to achieve the effectiveness of the goals. Try. You can take the horse to water, but the horse has got to drink. Completely emotional decision. You know, from that decision, I could just imagine the hundreds of thousands, if not millions of dollars from a dollar's perspective, but ultimately he's pushing himself further away from the actual numbers and the actual plan of getting to where you need to get to. And you could be in the best product you can. That decision is made completely emotionally with no rational thought. So I like that you've brought up behavior when it comes to effectiveness, because it's really passionate about me, because it's being able to kind of behave the right way consistently over time. And it's hard to do. It's hard to go to the gym 5-6 times a day. It's hard to wake up in the morning and go for a run. It's hard to do. But I think hard is where you find success. It's behind the hard, sitting there, that's where the success lies. Be investing, life, whatever it is. And if it's easy, you're probably not pushing yourself.
I tend to agree.
You know? And I find that the people that really achieve the life they want, not the life that they've accepted, there's been sacrifice. There's been hard. You know, it's not just been budgeting, it's the ability to earn more income. Biting down when the markets have crashed and you've consistently stuck to your plan. You know, sold down or trimmed down on certain things when risks were too high. It's hard. Like, when markets are rallying out of control and your advisor's saying to you, hey, listen, trim down your best assets that are making you the most amount of money, most people are like, what are you doing? Now, we understand there's the de-risking and going back to the buckets and everything we just talked about. And then, so that's a greed problem. It's an emotional greed problem. On the flip side, markets are crashing, and Mason's here telling it, listen, your stock portfolio or your property portfolio is now underweight where it needs to be. We now need to top up from your cash, from your safe assets into these risky assets that are dropping in value. The fear factor on the emotions, Mason, what are you doing? Now, logically, you know, it's usually the right decision because you're coming from a risk perspective, you're coming from a goals perspective of what asset allocation we require and the effectiveness of what that's going to be to ensure the certainty of achieving your goals. But emotions are playing in the way of deviating you from your plan. I feel a little bit weirdly positioned, Mason, because I've been in it since I was 14. And I always used to remember, I used to speak to people and kind of be like, why do you do this for? Because I don't know any different. However, I want everyone to know that this is what we live and breathe. This is what we do. And it creates certainty. And over so many years, I've seen so many people that have failed and I've seen so many people that have become successful. And I can tell you, pretty much like 80% of what being successful is what we've just talked about in this podcast. Don't you agree, Mason?
Consistency will get you much further than picking the right product. I think too often I see on different Facebook groups and Facebook communities and Instagram and all these things is debating, do I choose this ETF or this ETF?
Like the difference between VAS and IOZ.
Exactly. It means nothing.
And they're spending days.
It means nothing really. Like, cool, you might get a bit extra, whatever, but it's the consistency. So that person who's doing the $100 a month or $200 a month consistently, they're going to get a lot further than that person who's spent 6 months researching the different ETFs and hasn't really done anything. Hasn't taken action and hasn't been consistent with what they want to do. So I couldn't agree with that more. So I think managing that behavior, crucial.
Yeah. So it's really around buckets, efficiencies in both fees and taxes. Obviously choosing the right solution for the right goal, overlaid by the risk, and then applying the right mindset, behaviors, and habits, and then consistently be adjusting those and evolving those and improving those over time, which is also hard to be reminded to what you're trying to achieve. And so, like, I consistently, like, when I want to get fit, I put a goal and a milestone in front of me. If it's you, Mason, like doing a half marathon. So when you do your goals and when you do your thing, like stuff, make sure they're truly meaningful, because you don't want an effective investment strategy pointing to something that you don't really want either. Mason, it's been an absolute pleasure to have you on again. We always really go deep, and I know both of us are really passionate about this, but hopefully everyone got a really kind of good understanding about how we think about things and really some good insights and tips. So if you love this podcast, subscribe to our YouTube channel or make sure you follow us on all major podcast platforms. Until next time, see you later. Thanks, Mason.
See ya.